Hello everyone, welcome back to Gold Rush Reporter, your go-to channel for honest insights on gold and silver. I'm your analyst, breaking down the market trends so you can make smart decisions with your hard-earned money. Over the last 2 days, silver has dropped sharply, now trading at $50.62 per ounce. This is a critical moment where true stackers reveal themselves. Some see this as a sale and a buying opportunity, while others panic, worried that prices might fall further. Many new investors make the classic mistake of buying high and selling low. For example, silver recently peaked at $54. Those who bought at $54 panic when it drops below $46. Then, when it climbs back up to $54, they regret selling. The cycle repeats, trapping them in emotional decisions rather than logic-based investing. Take a step back and observe the pattern. Silver rises to $54, dips to $46, climbs back, then drops again. This volatility is normal, and panic selling at dips is exactly what you want to avoid. Experienced stackers understand that buying low and holding is the winning strategy, even during temporary drops. To put this in perspective, silver has historically reached $50 in 1980 and 2011. For new investors, seeing $50 today might feel expensive, but in reality, it's still historically high. Long-term stackers know that dips like this are opportunities to add more silver at a discount. The key is to ignore the emotional noise and focus on the bigger picture. People tend to overreact to short-term swings, but those who remain calm and consistent will always benefit in the long run. I want to hear from you. Comment below, did you buy at $54, $52 or $50? How do you manage panic selling? And if you find this insight valuable, hit the like button, share this with fellow stackers, and subscribe to Gold Rush Reporter for daily updates on precious metals. Remember, the market will always test your patience, but disciplined stackers know that staying steady is what pays off over time. Over the past few weeks, silver's volatility has been eye-opening. After the recent drop to 50 or 62, many investors are feeling nervous, thinking the worst is yet to come. But here's the truth. This is exactly the kind of market behavior that smart stackers capitalize on. The pattern we're seeing, a rise to $54, a fall to $46, and now hovering around 50, isn't unusual at all. Historically, silver has always experienced swings like this, and those who panic sell end up locking in losses unnecessarily. If you purchased at 52 or 53, you're still in a very strong position, especially if your mindset is long-term. The key takeaway is that emotional decisions, driven by fear of further drops, are the exact opposite of what builds wealth in precious metals. Some new investors see this price drop as a sign to cash out, thinking, I paid more before, so I should sell before it goes even lower. That mindset is exactly what leads to buying high and selling low. As I've repeatedly emphasized, the correct approach is to buy the dips and hold. Every pullback is an opportunity to increase your position at a better average cost. Those who understand this principle are the real stackers. Those who treat silver not as a speculative asset, but as insurance, a tangible store of value. Even at $50, silver remains historically valuable, and future appreciation is likely as global demand continues to rise. Right now, multiple factors are creating a perfect storm for silver accumulation. Silver has been added to the US critical minerals list, which opens the door to potential tariffs and shifts in global trade. Additionally, China has restricted silver imports, tightening the supply further. In India, upcoming policy changes will peg silver to gold at a 10-to-1 ratio, reinforcing silver's value as real money that can be traded. All of these factors point toward rising demand and a potential price surge. Investors who ignore these fundamentals and focus only on short-term price movements are missing the bigger picture. It's also important to note the psychological element of silver investing. Many people require validation or confirmation before they feel confident buying dips. They need reassurance that buying low is smart, even though the historical pattern has consistently proven it. A true stacker, on the other hand, is happy with any dip because it allows them to accumulate more at favorable prices. Understanding this mindset is essential if you want to succeed in the silver market. The market is always volatile, but volatility is a friend to disciplined stackers, not an enemy. Finally, don't forget the comparison with gold. Silver is more volatile due to its smaller market size, so movements of 10 to 15% are normal. Gold tends to be steadier, often moving in the opposite direction or at a slower pace. This relationship provides insight into how to diversify and hedge your precious metals portfolio. For serious investors, understanding these patterns and acting logically rather than emotionally is what separates the winners from the panicked sellers. Now, looking closer at the recent silver movements, it's clear that $50 is a significant psychological and technical level. Many new investors panic at this point, thinking the market is crashing, but this is simply part of the normal ebb and flow of a volatile asset like silver. Historically, after a drop like this, the market tends to stabilize before making its next move upward. The key is recognizing that silver's intrinsic value hasn't changed. Its industrial demand, limited supply, and role as a monetary hedge remain intact. Selling in panic at $50 is essentially giving up on a historically strong investment just because short-term emotions take over. Investors need to understand the difference between price noise and fundamental value. Just because silver dips temporarily doesn't mean it's losing worth. In fact, these dips are opportunities to strengthen positions at a discount. Those who bought at $54 may feel nervous seeing it at $50, but consider those who purchased at $46 previously. They're smiling because they understand accumulation over time. Real stackers focus on average cost, not daily price swings. If you want to succeed in precious metals, you must adopt this long-term perspective and ignore the panic-driven decisions of less informed traders. Global factors are also playing a significant role. The US critical minerals designation and China's import restrictions are tightening supply, while India's silver-gold peg strengthens silver's credibility as a tangible asset. These developments aren't short-term headlines. They have lasting effects on availability and price trends. Investors who recognize these signals early have an advantage, while those who react emotionally to minor dips often miss the real gains. The lesson here is simple. Silver isn't a get-rich-quick trade. It's a strategic asset for preservation of wealth and future growth. Technical analysis also supports a buying opportunity around this price. Previous bottoms at $46 have held, and the current pullback to $50 is within the expected fluctuation range. Traders who focus on short-term volatility may worry about missing the bottom. But the truth is, the market will continue to offer entry points. What matters is your approach. Consistent accumulation during dips rather than attempting to time the absolute bottom, which is nearly impossible. Each dip reinforces your long-term position and reduces the average cost per ounce, positioning you for stronger gains when the next rally comes. Psychology plays a huge role in investor behavior. Many panic because they've become desensitized to higher prices. They forget that $50 per ounce is still historically expensive compared to previous decades. Education and patience are your best tools here. Learning to stay calm when prices fall, focusing on fundamentals, and acting logically rather than emotionally will prevent costly mistakes. True stackers recognize opportunity in what others see as risk. While the broader market may react with fear, those with a disciplined approach continue building wealth quietly and effectively. Continuing from the previous discussion, let's focus on the behavior of silver in volatile markets and how investors can navigate it wisely. The current drop to $50 should not be interpreted as a market failure, but rather a natural correction in an asset that has been historically volatile. When silver reached $54, many jumped in out of fear of missing out, only to panic as it dipped. This is the classic mistake of buying high and selling low, which undermines long-term returns. Real stackers, on the other hand, see each dip as a buying opportunity, reinforcing their holdings and lowering their average cost per ounce. The difference is mindset. Emotional investors react, strategic investors plan. It's essential to remember that silver's volatility is both a challenge and an opportunity. Unlike gold, which tends to move steadily, silver can swing sharply due to its smaller market size and industrial demand influences. This makes short-term predictions tricky, but also creates multiple entry points for patient investors. For instance, after a drop from $54 to $50, the market historically finds support near $46 before rising again. Those who panic at $50 and sell are locking in losses unnecessarily, while disciplined stackers add more silver, positioning themselves for the next rally. Global developments further strengthen the long-term outlook for silver. The US adding silver to the critical minerals list signals increased strategic importance, potentially leading to tariffs and restrictions that limit supply. China's import ban also tightens availability, while India's decision to peg silver to gold introduces a new monetary dynamic that could support higher valuations over time. These macro factors don't change overnight, meaning the current price dip is temporary in the grand scheme. Investors who understand this can capitalize on the situation rather than fear it. From a technical perspective, we've seen repeated patterns where silver dips to $46.50 and rebounds toward $54.56. This creates a predictable cycle for disciplined accumulation. Attempting to time the exact bottom is often futile, but consistently buying during dips builds a stronger portfolio over time. Each purchase at lower prices reduces the average cost, improving potential returns when the next upward leg occurs. Patience and consistency are more profitable than trying to chase daily market movements, which are noisy and psychologically taxing. Finally, the psychological aspect cannot be overstated. Many investors fail because they focus on short-term fluctuations rather than the bigger picture. They forget that $50 per ounce remains historically high, despite being lower than recent peaks. This desensitization to elevated prices creates fear during natural corrections. True stackers recognize that volatility is a tool, not a threat. By maintaining a rational perspective, focusing on fundamentals, and seizing buying opportunities during dips, investors position themselves for long-term success. Emotional reactions are what the market anticipates. Disciplined accumulation is what ultimately wins. We've now reached the crucial conclusion of today's analysis, and it's important to tie everything together. The current silver price of $50 is not a reason for panic. It's an opportunity. Investors who remain calm, buy the dips, and focus on the long-term fundamentals will be rewarded. Remember, volatility is a normal part of the precious metals market, especially with silver. Its smaller market size and industrial demand cause sharp fluctuations, but these same factors create excellent buying opportunities. The key is discipline. Stick to a strategy of accumulating during corrections, never selling out of fear, and always keeping the bigger picture in mind. Global factors are also working in favor of silver's long-term prospects. The inclusion of silver on the US critical minerals list, the export restrictions imposed by China, and India's move to peg silver to gold all point toward tightening supply and increasing strategic value. These developments, combined with a historical structural deficit, indicate that the recent dip is temporary. True stackers understand this and view $50 as a discount rather than a loss. They know that silver's value will continue to rise, potentially reaching new all-time highs in the months and years ahead. Technical analysis further supports this outlook. Past patterns show that silver often finds a bottom near $46 and rebounds toward $54.56. Attempting to predict the exact bottom is unnecessary. Consistent accumulation during dips is the most effective strategy. By lowering your average cost per ounce over time, you maximize gains when the next upward cycle begins. Emotional reactions, on the other hand, only lock in losses and prevent long-term growth. Discipline, patience, and understanding of market mechanics are what separate successful stackers from those who repeatedly buy high and sell low. In terms of investment psychology, it's vital to remember that silver at $50 remains historically expensive compared to its average over decades. Many new investors fail to appreciate this, focusing solely on short-term drops. True stackers, however, understand that every dip is an opportunity to strengthen their position. They embrace volatility and use it to their advantage, recognizing that upward momentum will resume once panic-driven sellers exit the market. This mindset, coupled with a disciplined accumulation strategy, ensures long-term success in precious metals investing. Before we close, a reminder: stay vigilant, stay informed, and continue building your physical silver and gold holdings. The world is entering a period of economic uncertainty, and tangible assets like precious metals will be essential for preserving wealth. Don't be swayed by short-term price movements or market noise. Focus on fundamentals, buy the dips, and hold with confidence. Thank you for tuning in to Gold Rush Reporter, your trusted source for gold and silver analysis. If you found this update valuable, hit the like button, share it with fellow investors, and subscribe to stay informed on market developments. Keep stacking, stay prepared, and I'll see you in the next video with more insights on precious metals.